You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the deep dive. Today, we are strapping on the macro goggles because we really need to zoom in on the global financial landscape. You know, for months, our focus has rightly been on U.S. data, inflation, Fed guidance.
Absolutely. That's been the main story.
But right now, the domestic calendar is, well, sparse. Central banks seem to be mostly pausing.
They're taking a breath.
Exactly. So we have to shift our gaze, really focus outwards. We're talking currencies, commodities, trade policy, and yeah, that ever-present geopolitical edge.
That's exactly right. And for you, the listener, the mission today is pretty critical. We need to get a handle on the market's current mood. Our sources, they're calling it cautious positioning.
Cautious positioning.
Yeah. And the price action you're seeing, you know, whether it's oil futures or currency crosses, it's not really about domestic economic reports right now.
Right.
It's being driven mainly by these, let's say, three external forces: that lingering tariff talk between the big players, new developments coming out of China, geopolitically speaking, and that sort of constant low-level hum of headline risk from conflict zones.
So it's like background noise that occasionally gets louder?
Precisely. So we're trying to give you a shortcut today. Focus on the things that are actually generating some momentum.
Okay, so if the U.S. side is quiet, we got to look at these external levers that are moving the needle. Let's kick things off, as we often do, with the global wallet itself. Currencies.
Good place to start.
And specifically, the U.S. dollar. It seems firmer, yeah, but kind of stuck in a tight range. When things get uncertain, or maybe markets are thin, why is the greenback still the go-to, the absolute default choice, even when its own data isn't really shouting from the rooftops?
It's like, it's the ultimate inertia play, really. The dollar acts as the default safe haven simply because the overall risk tone globally is just a bit softer. When there's no flashing green light to buy riskier assets, investors just kind of default back to holding dollars. It lets the currency build up what analysts call a defensive bid.
Right, that term defensive bid. Can we quickly unpack that for listeners? What does that practically mean for how traders are thinking or positioning?
Sure. It means they're willing to pay a slightly higher price for the dollar, not because they're suddenly super bullish on the U.S. economy.
Got it.
But more as a shield, a defense mechanism. They're basically saying, okay, I'll hold dollars because I expect other things. Maybe stocks, maybe emerging market currencies might do worse. It's capital just looking for a temporary place to hide, essentially.
That paints a really clear picture. Okay, so the dollar's firming up defensively and elsewhere. Things look kind of subdued. The euro, for instance, pretty quiet after the ECB's familiar wait-and-see guidance.
Yeah, no surprises there. Gave the market basically nothing new.
And sterling. It drifted back below 1.34. Seems like just quiet UK news and that general global caution taking hold.
Pretty much. But, you know, the really interesting story, I think, is happening over in Asia, specifically with the yen.
Ah, yes.
It's really struggling, right near that crucial 151 level against the dollar.
Okay, let's pause there. Why is 151 always flagged as the crucial level, the handle we keep hearing about? What's special about it?
Well, historically, 151 has often been seen as a kind of line in the sand. It's a level that tends to draw more intense scrutiny, maybe even jawboning or outright intervention threats from Japan's Ministry of Finance.
Right, the MOF, not the BOJ.
Exactly. The Bank of Japan, you know, they generally like a weaker yen for export competitiveness. But the Ministry of Finance, they worry about import costs, inflation hitting consumers. So crossing 151 or even getting too close, it sends a signal that maybe things are moving too fast, too far, and intervention might be on the table to slow the decline.
That's vital context. Okay, so it's nearing that potential intervention zone. What's pushing it there?
Two key things coming out of our sources. First, there are reports suggesting the Bank of Japan sees, well, very little urgency to hike rates at their next meeting.
Still committed to easy money. Steadfastly committed. Ultra-loose policy continues. And second, you had that political confirmation, Takaichi securing the premiership. That signals political continuity.
And Takaichi is seen as favoring stability.
Exactly.
Yeah.
Which kind of reinforces the central bank's very gradualist, cautious approach. So you put it together, political stability feeds into monetary predictability.
Which in Japan means a soft yen.
Bingo. A perfect example of politics directly impacting FX right there.
Fascinating. Okay, let's look south from there to the antipodes. New Zealand dollar, the Kiwi lagging a bit. Softer local data, that seems straightforward enough.
Yeah, textbook.
But the Australian dollar, the AUD. Now that's interesting. Logically, you'd think it should be getting a lift, shouldn't it?
You would think so.
I mean, China's its biggest trading partner. China reported better activity data. The PBOC kept its loan prime rate steady. All positive signs, right?
Should be supportive.
Yet the AUD is still struggling. What's going on? What's blocking it? Why isn't it reflecting that relatively good news out of China? Okay. And this brings us right back full circle to that central theme we started with.
Trade policy uncertainty again.
That's the one. It's the single most powerful force acting on some of these currencies right now, the Aussie dollar. It's a classic example of what we call high beta FX.
High beta meaning highly sensitive.
Extremely sensitive. To global growth expectations, sure, but critically to the temperature of the U.S.-China trade relationship. So even if China's domestic numbers look okay, maybe even better than expected.
Like the factory output you mentioned.
Exactly. That sort of looming geopolitical cloud, the uncertainty around tariffs, trade talks, it just completely overshadows the positive local or regional data for a currency like the AUD.
Wow. So if I'm sitting there as a trader, I see good Chinese data, but I just can't trust it because I know one headline about tariffs could just blow up my position.
That's precisely the calculation.
Yeah.
The policy desk effectively trumps the economic data desk in this environment.
The uncertainty premium is just too high.
Exactly. It keeps the AUD grounded, unable to really capitalize on that positive news flow from Beijing.
Okay, so that really underscores the point.
Wow.
Policy, especially trade policy, seems to be the main driver, not just domestic data points. Let's transition right there then. The source material really hammers this home trade, and tariff developments remain the main macro lever.
They absolutely are. And what we have is this ongoing fundamental tension playing out. On one side, you've got the threat of more U.S. tariffs on China, that November 1st deadline that's been mentioned, still officially on the table in Washington.
So the hard policy threat is still there.
It is. But on the other hand, you have the diplomatic tone, which in recent briefings seems to have softened, maybe noticeably so.
How so?
Well, there's been talk, a leader-level meeting has been flagged for some time soon, and recent talks at the Treasury level were described using words like candid and constructive.
Candid and constructive. That sounds, well, better than hostile.
It does. It sounds more positive, certainly.
Yeah.
So you have this classic market push-pull, right?
The certainty of a threat versus the hope of a diplomatic off-ramp.
That is exactly the tension the market is glued to right now. Nobody wants to make a big bet until they have a clear idea of which way that pendulum is going to swing, and November 4th becomes a huge focal point because of that deadline.
But it feels like the narrative is also shifting, right? It's not just about tariffs anymore. It's increasingly about strategic supply chains, industrial competition. We saw that big development last week, the U.S. and Australia Critical Minerals Pact. And this wasn't just a statement. They put numbers on it. Targets for over $3 billion in public investment within 6 months. That sounds like serious money.
It is serious money. And what's really fascinating here, I think, is how clearly this shows industrial policy kind of operating under the umbrella of trade cooperation.
Right.
The U.S. is actively strategically trying to de-risk critical supply chains. This pact involves deeper cooperation on processing these minerals, not just digging them up. It brings Japan into some projects, too. And it specifically targets those supply chains for battery inputs and rare earth materials.
And just remind us, why are rare earths and battery inputs so critical that governments are committing billions?
Because they're foundational for, well, the 21st century economy. Everything from EVs, renewable energy infrastructure like wind turbines, to advanced semiconductors and defense tech relies heavily on them.
Okay.
And right now, the global processing and supply of these materials are highly concentrated in just a few places. So this pact, it's a direct geopolitical move aimed at diversifying and securing those industrial inputs for the long haul. It links trade deals directly to national industrial strategy.
And it shows the breadth of U.S. trade policy, too. It's not just the big players. We saw the USTR proposing hefty duties, up to 100%, on Nicaragua after a Section 301 probe.
Right, showing they'll use big tools even on smaller partners.
And moving to suspend CAFTA-DR benefits. But on a slightly more positive note, Seoul apparently thinks the odds of getting some kind of U.S. trade arrangement done by the APEC summit have actually improved.
Yeah, so a mixed bag of actions. And if we quickly swing back to Europe, that situation with the Netherlands and the chip company in Xperia, it's almost a perfect little micro example of this global shift.
How so?
Well, even while the Dutch government is trying to sort of defuse broader commercial tensions with Beijing, they're absolutely standing firm on their security intervention regarding that specific high-tech asset, Xperia.
The national security angle.
Exactly. It shows the focus isn't just on general tariffs anymore. It's about protecting very targeted, specific technology nodes within crucial supply chains. That really is the new frontier of trade policy, control over key tech inputs.
Okay, we've definitely nailed the policy side. But if policy and geopolitics are calling the shots, I'm really keen to know how that's playing out in the commodity markets. Let's shift there. The picture seems mixed.
It is.
Starting with crude oil. It's been choppy, but now it's broadly flat. Why the stability all of a sudden? If the Middle East situation is still being called fragile, why aren't we seeing a bigger risk premium in the oil price?
It's a geopolitical balancing act, and it's been surprisingly effective, maybe. The Middle East risks, they bubble up, they simmer down, but crucially,
No actual supply shock.
no fresh, tangible supply shock. Tankers are still moving through key roads, so the immediate fear factor, it seems to have plateaued a bit. Market attention is actually subtly shifted away from just focusing on immediate supply risks in the Gulf,
Shifted to what?
toward thinking about potential diplomatic timelines, maybe concerning the Russia-Ukraine conflict, which speaks more to longer-term demand expectations rather than just immediate supply fears.
Interesting. Okay, shifting to another traditional safe haven, gold. It's backing off those recent record highs. Is this just a simple mechanical thing? The dollar is stronger, so the fear of currency debasement cools off a bit, making the dollar look better short term.
That's certainly the main mechanical driver for the pullback, yes. When the dollar firms up, gold usually loses some of its shine relative to it. But, and this is the crucial caveat our sources highlight, gold is still seen as heavily underpinned.
Underpinned, meaning it has a floor.
Think of it like that, yeah. There's a strong base of support. Why? Because that lingering policy uncertainty we talked about, inflation risks that haven't totally vanished, and just the general geopolitical friction, all that continues to support the broader bid for precious metals. Gold is consolidating, maybe waiting for the next big fear signal, but a collapse seems unlikely because of that underlying uncertainty.
Got it. Now, base metals, let's talk copper specifically. They're softer today, despite what should be good news from China, right? The party plenum is ongoing. We had that better activity data recently.
We did. Q3 growth, industrial output, retail sales all matched or beat forecasts.
So China's the world's biggest copper consumer. Why isn't that positive data translating into price support for copper? What's the block?
It's another perfect example of policy risk trumping fundamentals right now, just like the Aussie dollar we discussed.
Same story.
Same story. Copper had some earlier strength, but it faded because the markets are basically holding their breath, waiting for the next concrete signal on U.S.-China policy before committing significant capital.
They need to know the trade rules before betting on industrial demand.
Precisely. That geopolitical caution is just overriding what should otherwise be quite supportive news from the Chinese economy. The market needs clarity on the big picture before it trusts the smaller picture data points.
That really makes the geopolitical backdrop incredibly important context for understanding why markets are where they are, sort of stable, but cautiously so. Can we quickly summarize the state of play and the key hotspots based on the sources?
Sure. Middle East. The word is fragile, but contained for now. Aid flows. The Rafah crossing operations apparently being calibrated quite carefully against hostage release milestones. So humanitarian moves tied directly to security progress.
Okay, delicate calibration.
Right.
And Russia-Ukraine.
On that front, the sources point to, well, maybe slightly improved dialogue, albeit incremental. A recent U.S.-Russia leaders' call was termed productive. Staff-level meetings are planned. And crucially, the IAEA is reporting that localized ceasefires are actually allowing repairs to the Zaporizhzhia nuclear plant's offsite power lines.
So small steps toward stabilization.
Small steps, but they help remove some of the absolute worst-case tail risks, particularly for energy and commodity markets.
Okay, so let's bring it all together then. We've got these simmering trade tensions, defensively firm currencies, conflicts that are sort of contained but still risky. What does this whole environment mean for you, the listener, watching the markets today?
Yeah, the big picture narrative, the overarching theme, it really remains one of cautious positioning. The market isn't hitting the panic button. Definitely not.
Right.
But nor is it aggressively deploying capital into risky assets. So the dollar holds that modest defensive bid we talked about. Oil is kind of marking time, waiting for a clearer signal. Gold is consolidating its gains.
Holding its breath.
Investors are essentially holding their breath, yeah. Waiting until one of those key external levers, trade policy, China developments, or conflict headlines, gives a much clearer new direction.
All right. And looking just ahead, say the next few sessions, what are the concrete, immediate signals we should be watching for based on the analysis? What are the top 3 things?
Okay, 3 key things to watch. First, and most importantly, any concrete movement or even just official language regarding U.S.-China trade, especially with that November 1st tariff deadline looming.
Okay, number 1, U.S.-China trade signal.
Number 2, keep an eye out for Canada's CPI release. North American inflation data, even from Canada, it always has the potential to ripple through and affect risk sentiment globally.
Got it. Canada CPI, and
Third, monitor any public remarks from key central bank officials around the world. An unexpected comment on interest rates or a shift in tone about the economic outlook, especially from the Fed, ECB, or BOJ, could quickly change the mood in currency markets.
Okay, so trade talk, Canada CPI, and central banker speeches. That gives us a really clear, actionable checklist to track the macro pulse.
Thank you. That was a great walkthrough of a complex picture.
My pleasure. And maybe just to leave you with one final provocative thought to mull over, let's circle back quickly to Japan.
We talked about how political continuity there, with Takaichi securing the premiership, strongly reinforces the Bank of Japan's super gradualist monetary policy path.
Right, stability equals soft yen for now.
Exactly. It suggests this continued, almost strange decoupling of domestic political stability from any real short-term urgency on the FX front.
Yeah.
So the question for you to think about is, how long can that specific balancing act last? How long before that political continuity eventually translates into undeniable pressure, maybe from the Ministry of Finance worried about imports, maybe from international partners pressure for the Bank of Japan to finally take more decisive monetary action? When does stability force a change?
Fascinating tension indeed. Politics versus economic reality. There are lots to watch there. All right, that's it for this deep dive. We'll talk to you next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.